Price built, how markets discover value. Before we continue deeper into this exploration of how markets discover value, allow me to pause for a brief moment. If any part of today's discussion has struck a chord with you, whether a clear explanation of price formation, a revealing insight into the role of derivatives, or a fresh perspective on economic coordination, please consider liking the episode, sharing it with others who might find it valuable, and following for future editions. Your support truly helps sustain and expand this series of thoughtful examinations into the mechanisms that shape our economic world. Thank you. Now let us proceed. We're looking into the fascinating world of how prices come to be in financial markets. It's like peeling back the layers of an onion to see what makes economies tick, from the simplest trades to the wild complexities of derivatives. By the end, you'll have a clearer picture of why prices aren't just numbers. They're signals that guide everything from what gets produced to how resources flow. Stick around as we explore this step by step. Let's start with a quick glimpse without giving away the full mechanics. Imagine walking into a bustling marketplace where buyers and sellers haggle over goods. That's the essence of price formation at its core, a dance of supply and demand that sets values in real time. We'll build from there to more intricate systems where computers and contracts play huge roles, showing how these layers add efficiency but also risks. It's all about understanding that prices emerge from countless interactions, revealing hidden information that no single person could grasp alone. This journey will highlight why this process is so vital for innovation and resource use, contrasting it with alternatives that fall short. Now, let's get into the heart of it all. We'll cover the basics first, then layer on the complexities, just like building a house from foundation to roof. At the simplest level, prices are discovered through exchanges where buyers and sellers meet. Think of a stock market or even a local auction. Buyers put in bids, the highest amount they're willing to pay for something like a share of a company. Sellers counter with asks, the lowest they'll accept. These stack up in what's called an order book. The best bid sits at the top for buyers, and the lowest ask for sellers. The difference between them is the spread. When a bid meets or beats an ask, a trade happens, and that's your market price right there. It's pure supply and demand in action. If more people want to buy than sell, bids rise, pushing prices up. If sellers flood the market, asks drop, and prices fall. Factors like liquidity, how many participants are involved, tighten that spread, making prices fairer. Information flows in too. A positive earnings report might spike demand, while bad news tanks it. Even psychology creeps in. Fear during a downturn or greed in a boom can swing things wildly. This process isn't static. It's dynamic, constantly adjusting to new realities. But markets aren't just manual haggling anymore. We add tools to make trades smarter and faster. Enter order types, which automate decisions and influence how prices form. A market order says buy or sell right now at the current price. Great for urgency, but risky in volatile times because you might pay more than expected. Limit orders give control. Buy only if the price is below a certain level or sell above one. They don't always execute if the market doesn't hit your target, but they prevent bad deals. Then there's stop loss. If the price drops to a set point, it triggers a sale to cut losses automatically. Stop limit combines that with a price range for even more precision. Trailing stops are clever. They adjust upward as prices rise, locking in gains without constant monitoring. These orders cluster at key levels, creating support or resistance that can stabilize or jolt prices. In low-volume markets, a big limit order might even move the price itself. Things get really exciting with automation. Algorithmic trading uses math models to execute trades based on price, volume, timing, and more. It started gaining traction decades ago and now handles most market activity. Variations include strategies like volume-weighted average price, which spreads trades to minimize impact, or time-weighted ones that pace evenly. High-frequency trading is the extreme version, computers making thousands of moves in microseconds, sniping tiny profits from inefficiencies. This speeds up price discovery, incorporating news almost instantly and boosting liquidity. But it can amplify volatility, like in sudden crashes where Algos chain react. Overall, these systems make markets more efficient by processing vast data humans can't, though they raise questions about fairness when big players dominate. Moving to futures contracts, these are agreements to buy or sell an asset at a predetermined price on a future date. They're standardized and traded on exchanges, covering everything from commodities like oil to financial indexes. You can go long, betting on a rise, or short on a fall. Settlement might be cash or actual delivery, but most are for speculation or hedging. Price discovery here anticipates the spot market, the current cash price. Futures reflect collective bets on future supply and demand, influenced by economic data, weather, or geopolitics. They influence underlying prices through arbitrage. If futures are higher than spot, traders buy spot and sell futures, pulling them together. Hedging is key. A producer sells futures to lock in prices against drops, stabilizing the whole chain. But leverage amps it up. You might control a large contract with just a fraction down as margin, magnifying gains or losses. If things go south, margin calls kick in, brokers demand more cash to cover, or they liquidate positions, which can cascade into bigger market moves. Options add another layer. These give the right, but not the obligation to buy or sell at a strike price by expiration. Calls are for betting on rises. Pay a premium for the chance to buy low if it surges. Puts protect against falls. Premiums factor in time, volatility, and how far the strike is from current price. American options can be exercised anytime. European only at end. They influence prices indirectly through hedging. If lots of calls are bought, sellers might buy the underlying to delta hedge, pushing prices up. Puts can depress them. Near expiration, gamma effects can cause sharp swings as positions adjust. Leverage here is huge, control big exposures with small premiums, but you can lose the whole premium if wrong. Broadening out, derivatives encompass futures, options, and more like forwards, custom versions without exchange backing, riskier due to counterparty default, and swaps where parties exchange cash flows, say fixed for floating interest. These tools derive value from underlyings and aid discovery by pooling expectations, adding liquidity, and allocating risks better. They often lead spot prices, especially in volatile times, improving overall efficiency but sometimes exaggerating bubbles or crashes through feedback loops. Leverage ties it all together, letting you borrow to amplify positions. In derivatives, it's built in. You control $100,000 with $10,000 margin. Great for returns, but losses hit hard, potentially exceeding your initial outlay. Margin calls enforce discipline. If equity dips below maintenance, add funds or get forced out, which in panics can fuel fire sales. Wrapping the details, we've seen how prices build from basic bids to sophisticated instruments, each layer adding depth to discovery. Diving into themes and analysis, the core power of this process lies in how markets harness dispersed knowledge to allocate resources efficiently. In free markets, prices act as signals, coordinating countless individual decisions without a top-down command. No one person holds all the info on scarcities, preferences, or innovations. It's spread out among millions. Through trades, prices aggregate that, guiding production toward what's valued most. For instance, a rising price signals shortage, drawing more supply, falling ones cut waste. This drives innovation too. Firms compete to lower costs or improve goods, knowing prices reflect real demand. Contrast this with centrally planned systems like those under Bolshevism or communist regimes, where allocation lacks true prices. Without market exchanges, planners can't rationally value resources. Capital goods become mere transfers, unpriced, leading to inefficiency and waste. Historical critiques from the early 20th century, like those tracing back to debates in the 1920s, highlight this economic calculation problem. Central authorities miss the nuanced local knowledge that prices reveal. Markets, by decentralizing decisions, limit power concentrations and foster adaptability. They turn self-interest into societal benefit as competition discovers better ways. Sure, markets have flaws, like volatility from leverage or algos, but they outperform planning by embracing uncertainty and rewarding alertness. Derivatives enhance this, transmitting future expectations to spot prices, completing markets that might otherwise lack tools for risk management. In mature economies, they boost efficiency. In emerging ones, they attract capital but require safeguards against excess. Ultimately, this discovery process isn't perfect, but it's the best for creating wealth and responding to change. To bring this home, here are some standout lines that capture the essence. One early thinker put it this way: the pricing systems in communist economies were necessarily deficient because if a public entity owned all the means of production, no rational prices could be obtained for capital goods as they were merely internal transfers. Another emphasized, we must look at the price system as such a mechanism for communicating information if we want to understand its real function. And on competition, it constitutes a discovery procedure which we would not need if we could predict its results. These highlight how prices aren't arbitrary, they're vital coordinators. In closing, grasping how markets build prices equips you to navigate finance smarter, whether investing or just understanding the world. Explore exchanges, try paper trading, or read up on economic history to see these ideas play out. Thanks for joining this exploration. May your own discoveries be fruitful. Keep learning. Stay free.